Welcome! In this video we will unpack a powerful yet often overlooked strategy: tax gain harvesting at the 0% long-term capital gains rate. First, we will define what the strategy is and why it matters. Next, we will look at the income thresholds and the role of the standard deduction. Then, we will walk through a step-by-step plan and a practical example. After that, we will examine pitfalls, credits, and state tax considerations. Finally, we will summarize key points, quiz your understanding, and share a concise checklist. Let's begin. Here is our roadmap. First, we introduce tax gain harvestings. Second, we explain how the 0% long-term capital gains bracket works, and how the standard deduction expands your capacity to harvest gains tax-free. Third, we provide a step-by-step playbook and then a worked example. Next, we cover pitfalls, including federal credits and state tax impacts. Then, we compare gain harvesting with loss harvesting. After that, we give you a practical checklist, followed by a short quiz. Finally, we wrap up with key takeaways and next steps. The key idea is using low-income years to realize long-term capital gains at a 0% federal tax rate, effectively stepping up your cost basis without paying federal taxes now. This allows you to repurchase immediately, because the wash sale rule applies only to losses, not gains. As a result, you reduce future taxable gains and gain more flexibility for rebalancing. However, this only applies to assets held longer than 1 year, and you must consider the impact on credits and state income taxes. With that foundation, let's define the strategy more precisely. Tax gain harvesting is the practice of selling appreciated assets that qualify for long-term capital gains, realizing the gain while your taxable income is low enough that the federal rate on those gains is 0, and then immediately repurchasing the same asset to reset your cost basis higher. This reduces your eventual tax when you sell later. It works because long-term capital gains have a 0% bracket up to certain taxable income thresholds. The standard deduction lowers taxable income, effectively increasing how much gain can fit within the 0% bracket. The wash sale rule does not apply to gains, so you can repurchase immediately to remain invested. This is especially beneficial in years when your income is temporarily low, such as early retirement, a sabbatical, or years with large deductions. These are approximate 2024 taxable income thresholds for the 0% long-term capital gains bracket. Always verify the current year's IRS numbers, since they change annually. Remember, these thresholds refer to taxable income, not gross income. The standard deduction reduces taxable income, which expands the amount of gains you can realize at 0%. As we move forward, we will incorporate these thresholds into a practical workflow. Follow these steps. First, ensure the asset qualifies as long-term by confirming you have held it for more than 1 year. Second, estimate your ordinary income, including wages, interest, and non-qualified dividends. Third, incorporate the standard deduction to determine your expected taxable income. Fourth, include qualified dividends and any long-term gains to see where you sit within the 0% bracket. Fifth, compute your harvest capacity using the formula: 0% long-term capital gain ceiling minus the sum of taxable ordinary income, qualified dividends, and any existing long-term gains. Sixth, select which tax lots to harvest, favoring those with the highest embedded gains and assets you plan to hold for many years. Seventh, execute the trades, selling and immediately repurchasing to remain invested. Doing so avoids wash sale concerns because those apply to losses, not gains. Eighth, carefully document the new cost basis and acquisition dates. Ninth, reassess the effects on federal credits, health insurance subsidies, and income-related premium adjustments. Finally, account for any state-level taxation, since many states tax capital gains as ordinary income. This flowchart visualizes the decision sequence. You start by determining whether it is a low-income year. If it is not, you typically defer harvesting and revisit next year. If it is, you confirm that the positions are long-term. Next, you estimate taxable income after applying the standard deduction and compute your headroom within the 0% long-term capital gains bracket. If you have headroom, you proceed to sell appreciated assets, immediately repurchase to reset the basis, and then record the new basis details. Finally, you check for any side effects on credits and state taxes. If you do not have headroom, you defer and reassess in the following tax year. Consider a single filer with approximately $10,000 of wage income, $500 of interest, and $500 of qualified dividends. Using the 2024 standard deduction for a single filer, the ordinary taxable income is effectively reduced to zero. The approximate 0% long-term capital gain ceiling for 2024 is $47,025 of taxable income. Because qualified dividends count toward this limit, the filer has about $46,525 of capacity for long-term gains at 0% federal tax. In practice, realizing roughly $46,000 of long-term gains would remain within the bracket. The investor sells appreciated long-term positions and immediately repurchases to reset the cost basis higher, staying fully invested. This locks in a free step-up in basis while incurring no federal tax in this example. Always check current year thresholds before executing. Here is a side-by-side comparison. Tax gain harvesting focuses on realizing long-term gains during low-income years to reset the basis higher, reducing future taxes. It is most effective when you can fit those gains within the 0% bracket. The wash sale rule does not apply to gains, which permits immediate repurchase. However, realize that gains increase investment income and may affect credits. In contrast, tax loss harvesting realizes losses to offset gains or up to $3,000 of ordinary income each year, often during market downturns. The wash sale rule tightly governs loss harvesting, disallowing losses if you repurchase substantially identical securities within the restricted window. Loss harvesting can lower current taxable income and, in some cases, help with eligibility thresholds. Watch for these pitfalls. First, gains must be long-term. Short-term gains do not qualify for the 0% brackets. Second, higher investment income can jeopardize eligibility for certain credits, notably the Earned Income Tax Credit, which has an investment income limit around $12,000 depending on the year. Third, increasing your modified adjusted gross income can reduce health insurance subsidies under the Affordable Care Act. Fourth, remember state taxes, since many states treat capital gains as ordinary income. Fifth, mutual funds may distribute capital gains late in the year, unexpectedly consuming space in your 0% bracket. Sixth, the net investment income tax generally affects higher incomes, but you should still know the thresholds. Seventh, perform this only in taxable accounts. Retirement accounts have different rules. Finally, maintain careful records of your new cost basis and acquisition dates. Quiz time. Which statement about tax gain harvesting is true? Option A says the wash sale rule blocks you from rebuying after realizing gains. Option B says short-term gains qualify for the 0% long-term capital gains bracket. Option C says the standard deduction can expand how much gain fits in the 0% bracket. Option D says you can only harvest gains inside an IRA. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is that the standard deduction can expand how much gain fits in the 0% bracket. The wash sale rule applies to losses, not gains, so it does not prevent immediate repurchase after realizing gains. Short-term gains are not eligible for the long-term capital gains preferential rates. Finally, gain harvesting is a taxable account strategy, not something you carry out inside tax-advantaged retirement accounts. This timeline shows a practical annual cadence. In the first quarter, build an initial income projection. Mid-year, update those projections, and keep an eye on dividends and potential fund distributions. In early fourth quarter, estimate your remaining headroom within the 0% capital gains bracket. In late fourth quarter, execute harvest trades before the December 31st deadline, as capital gains are recognized on a calendar year basis. In early first quarter of the following year, document the new basis, evaluate credit and state tax impacts, and plan for the next cycle. Use this checklist before placing trades. Confirm the long-term holding period first. Project income and apply the standard deduction. Include qualified dividends in your calculations. Compute your headroom within the 0% bracket and set a target harvest amount. Execute the sell and immediate rebuy to reset the basis while staying invested. Record the new basis and lot details. Reassess any impacts on credits, subsidies, and state taxes. Finally, verify the current IRS thresholds each year. Disclaimer: this content is for educational purposes only and does not constitute tax, legal, or investment advice. Individual situations vary, and tax laws and thresholds change. Before acting, consult a qualified tax professional and verify current IRS and state guidance, including credit eligibility rules and income limits. To wrap up, Tax gain harvesting lets you take advantage of the 0% long-term capital gains bracket to reset your cost basis and reduce future taxes. The standard deduction expands how much you can harvest in low-income years. Execute only with long-term holdings, and monitor the consequences for credits and state taxes. Plan using income projections and complete harvesting by year-end. Finally, document everything and verify the latest thresholds annually. Next, we will close with a quick thank you and your call to action. Thank you for watching. If you found this helpful, please like the video, share it with someone who could benefit, and subscribe for more practical tax and investing strategies. Finally, tell us in the comments what scenario you plan to use for tax gain harvesting, or any questions you have so we can help.